if you can just kind of forgive us, we had a little technical issue and started broadcasting sooner than we had expected. Eleni, I do not have the question access, and I would like it so that if people have questions, I can see them. Can you give me that, please?
There you go.
Got it. Okay, thank you. Terrific. So we're just going to wait then for maybe about 4 more minutes to get started.
Okay. I hear like an ambulance. Is there any way can I tune out the other sounds?
Unfortunately, Eleni, unless you have earphones I can use.
Yeah, no, what you can do is when you're not talking, you can mute yourself.
Okay, I'll just do that. Okay, just another couple minutes and we'll get started.
Okay.
Okay, good afternoon. It's noon, so we're just going to go ahead and get started. Welcome to the webinar from the Women's Business Development Center here in Chicago called Boosting Your Bottom Line, Preparing Your Business for Tax Time. We are glad that we've got so many folks on the phone today. We're on the webinar. And I'd like to introduce our presenter. But before that, a couple of housekeeping items. You, as attendees, are all on mute mode, and we do have the question function operational. So if you have questions, please go ahead and just type them in as you think of them. I'll be monitoring them, and then at the end, I'll be able to ask Deanna the questions, and we can talk through those things. But you might as well just go ahead and write them down when you're thinking about them so that you don't forget them. The raising hands feature is not very functional, so we're not going to be using that. This will be recorded and then available on our website at a later time. So my name is Karen Goldner, and I'm the director of the Small Business Development Center here at the Women's Business Development Center. We are a full-service organization, a nonprofit organization whose business is helping your business grow. We do everything from individual one-on-one advising about starting and growing businesses on various topics, from just how do you get started to how do you increase your sales and work with selling to corporations. We provide lending services in the Chicagoland area. We also certify women business enterprise companies, so women-owned businesses that want to sell to corporations, and we work with companies that want to be able to sell to the government. So we are available at wbdc.org and look forward to working with you if we haven't already. And then I want to give a special thanks to our presenter today, Deanna Grant. Deanna is owner of Grant's Financial Services in the South Loop here in Chicago. She's got over 15 years of accounting, bookkeeping, and tax preparation work, and is bringing that to her business and is bringing those all that expertise to us today. So I'm going to just flip it over to Deanna, and thank you very much.
Hello, hi. As she mentioned, I am Deanna Grant of Grant's Financial Services, and we're a small business tax and accounting firm located in the South Loop. Our mission, or my mission, as I'll say president of my organization, is to, along with the Women's Business Development Center, to empower women to understand their financial statement, or I'll say their financial story, because in business, your business tells your story. But to understand your financial story so that we can create financial history. And my hashtag for this year is $1 at a time. You can do everything $1 at a time. But today we're going to discuss preparing yourself for business taxes, and what does that mean exactly. So preparing your business for business taxes, and I apologize. Can everyone see my full screen? Because I see the webinar thing on the side. I just want to make sure. Okay. So preparing your business for business taxes. So we first start off with how do you prepare yourself? How do you prepare your business for tax time? Well, it starts with keeping good books and records. Right? So I have a picture of a box of receipts, and that's fine. So as business owners, as long as we're capturing all of our expenses, then we can take the expenses to deduct on our taxes. But to prepare yourself, you should keep good books and records. Well, what does that mean exactly? Right? If you had that big box of receipts, that means sorting the receipts by category. So you sort the receipts by category. But what we don't know is the IRS, if you have a business, the IRS actually has rules and regulations. So one of their regs is to, if you have a business, that you are mandated to keep good books and records. So good books and records could mean keeping up the receipts with the receipts, but that means sorting them by category and also keeping track of every receipt for business, but also keeping good books and records, but also just having books and records, actually having books and records. And so not only keeping up with your expenses, but that means your income as well. So the IRS says everyone must keep good books and records. Having good books and records, they help you to monitor the progress of your business, prepare your financial statements, identify your different receipts, and what that means, your different sources of income, keep track of deductible expenses. And when you do that, when you identify your source of your receipts or source of income, and also keep up with your deductible expenses, then you are ready for tax time by keeping up with your income, all the income you collected as a business for the year, and all of your supported expenses. So those expenses and keeping up with those receipts and the expenditures, they help support anything that you would add on your tax return. So if you included the income or the expense on your tax return, if you were audited by the IRS, then you would have to show proof of every single line item on your tax return. Line item means exactly those expense items, and on the tax return we put them on certain lines. So I'm sorry, I'm an accountant, tax jargon, but line items are keeping them with your income that would go on certain tax form lines, as well as your deductible expenses. But good books and records actually increase the likelihood of your business success. My next slide is, how can we keep good books and records? So we saw the big box of receipts. Well, actually now in our world of accounting and cloud-based software and having software, there are some softwares that we can use to help us keep track of our expenses throughout the year, right? And what I like most about the cloud-based accounting systems, because there's several accounting systems, so using an Excel spreadsheet is okay. That is an acceptable way to keep track of your income, expenses, and your records. But what I really like about cloud-based systems is, as entrepreneurs and we're on the go, we can access our books and records on a regular, consistent basis, as well as access it on the go. So if you have a smartphone, an iPhone, a tablet, or a computer access, you can, or if you travel, you have access to your income and your expenses from, as long as you have an internet connection. So there are several softwares. There is QuickBooks Online, which at this point, I've been in this industry for the last 15 years, and so QuickBooks has been my software of choice. However, there are several different options with several different price points. So there's QuickBooks Online, there's something called Checkbook, there's FreshBooks, and there's Expensify. Expensify is actually free as long as you're keeping track of expenses only. The thing I really like about Expensify is that you can, with your smartphone or tablet, actually take a picture of your receipt. Because what happens when we have that big box of receipts, usually by the time the year is over, they smudge. So when they're rubbing together, they smudge, and then you cannot see the expense amount. You can't see how much you spent at Starbucks, right? So with Expensify, you can actually take a picture of your receipt and upload it to Expensify, and it'll categorize it for you. The expense portion of the software is actually free. But if you want to include income and expense, which helps us for tax time, having income and expense information, then there's a small fee, and it's probably like $9.99. FreshBooks is my second online software of choice, and FreshBooks is very user-friendly. It's actually more user-friendly, in my opinion, than QuickBooks Online. And FreshBooks, they have made the software to cater to, I'll say, independent contractors, like independent professional contractors. So if you are a PR person, if you have even for me, like an accounting firm, and IT person, IT consulting, not necessarily for restaurants, nor would I wouldn't use it for restaurants. I would not use it for nonprofits, because it does not keep track of the additional categorization that you need. Or I would not use it if I had a product with a lot of, where you need more detail in your accounting. I would not use FreshBooks. But if you're like an independent contractor with a PR firm, and basically you have simple ins and outs, meaning your income is only with maybe 1 or 2 profit centers, and your expenses are straightforward, then it's easy to use, and it's really good with invoicing and collecting on your invoices. Their invoicing system is amazing. But these are some different software so that you can keep good books and records, which is part of the process of getting ready for tax time. Now, if you download these softwares today, you can actually go back at least 6 months, and you can import your information for 6 months. So then that way, when you come to get your taxes prepared, you would, the first 6 months, if you have not entered anything, you'll have to enter it manually, but you can actually then use the electronic software to download the last 6 months. So the next thing we'll talk about is what is tax deductible and what is not tax deductible for your business. So what can I deduct? The IRS allows you to deduct ordinary and necessary expenses, right? What does that mean, ordinary and necessary? I have two examples. So the deduction of choice that I'm going to use for my example is magazine subscription. Okay, so if you are we have two examples. So if you own a hair salon and as a business owner, you actually subscribe to a magazine, right? So just say that's $15 for the year. Because we know that in the hair salon industry that having magazines is an ordinary, meaning it's very common, a common practice, and I don't want to say it's necessary, but long story short, it definitely is ordinary and necessary part of your business, then you are able to, the IRS will allow you to deduct that magazine subscription. Now, if you, and this is, and what I think the magazine of choice, it would be like more fashion magazines, clothing magazines, any magazines that are not related to the hair care industry, because that is what happens in salons. Now, if you are a home health care, if you have a home health care business, right, and you are watching a senior as part of your home health care business, and then you happen to go get Essence magazine, well, Essence is I'll say fashion magazine, that would not be an ordinary nor necessary deduction, because just because you're a home health care worker and you're watching the senior and they happen to be asleep all day and you want to read magazines, that is not considered an ordinary or necessary deduction. So the IRS allows you to deduct ordinary and necessary deductions. The second point is contractors, independent contractors. So an independent contractor is an individual that you paid independent contractor is someone who's basically independent of your business. So they may help you with your PR, they may help you with, not necessarily accounting, but they may help you, I don't know, mow the lawn, or they are not an employee. That's what it is. A contractor is someone you paid for services and they're not an employee. Well, the IRS says if you pay them $600 or more in a calendar year, that to deduct the expense, you need to issue that person a 1099 form. You need to issue contractors 1099 forms. So I know in our practice we're getting ready for tax time, so we are now preparing 1099s. But that is an ordinary deduction. It's an ordinary necessary deduction, but you can deduct it on your business taxes, and you need to actually fill out a form 1099, and there's paperwork that you would remit to the IRS in order to deduct it for it to be a valid deduction. If you pay someone $600 or more, then you should give that person, an individual, a 1099 form. Of course, W-2 employees, the salaries and wages are an ordinary necessary deduction, and that you can deduct on your taxes. Home office deduction, usually with the home office deduction, you get to deduct a percentage of your utilities, rent, and the utility, rent, home mortgage interest if you were having an office in your home, your insurance and real estate taxes, and usually that percentage is, I do it by the number of rooms in the house. So if you have 4 rooms in your house and 1 room, you're supposed to have a dedicated area for that home office. So if 1 room out of your 4 is for your home office, then you get to deduct 1/4, 25% of those expenses of all, like the total for the year of the utilities, if the rent and or share of mortgage interest, insurance and real estate taxes, you would deduct 25% of that on your business taxes. You can deduct business gifts up to $25 per client. So if you give out gift cards and different things for promotional purposes, they should be limited to $25. You also can deduct your auto expense, so actual versus mileage. I find that the mileage deduction is a larger deduction, and so you should keep track of your miles. So in order to deduct the mileage, you should keep a mileage log. Now, of course, like I said, we're in the 21st century. There is an app. There are a few apps to keep track of your mileage, so it'll easily allow you to keep track of your mileage. There's an app. My app of choice is Mileage IQ. Mileage IQ allows you to keep a mileage log in your phone. So then when it's time for tax time, you just you submit the report to your tax preparer for mileage. Or you have to keep a log, and a log means I drove from, you track where you went, and you say, and you look at your odometer, and if you started out at 10,000 miles, so you'll say 10,000 miles. When you get to your location, you'll say 10,050 miles, so that's 50 miles, and then you have to have a reason for that, for the log. So what that, if you're an insurance person, I went to go see my client, I went to go see client A for an appointment, and you just track it, and you have to track every single time you drive in your car. But like I said, and I think the mileage rate is at least 55 cents a mile. They change that every single year, but I find that the mileage deduction is more of a deduction than actual gas and gas repairs and maintenance on a vehicle. So there's a deductible. Oh, yes?
I'm sorry to interrupt you. We had one question that I wanted to just zip on because it was about the 1099. Tracy asked, if I'm an S Corp and I pay myself, do I have to issue myself a 1099?
Okay, so no. If you're an S Corp and you pay yourself, you do that. Okay, that's a tricky question. But as an S Corp, right? As an S Corp, the IRS has a regulation for S Corps, and if you're an S Corp, you as an S Corp is a tax saving strategy. And the IRS now wants you to pay yourself like a reasonable compensation. So the new law is, there's a law with the IRS called reasonable compensation. So an owner of an S Corp that pays themselves, because S Corp is like a tax loophole, you are supposed to actually pay yourself a W-2 salary, right? And you should pay yourself reasonable compensation. So what would someone reasonably be paid to do to provide the service that you provide? So if you're a PR person and a PR person in the market gets paid $20,000 a year, you should actually W-2 yourself $20,000 a year. Now, I understand when you're starting an S Corp, sometimes we don't have enough cash or capital to pay ourselves a salary. So for me to answer that question, the answer is no to the 1099 as an S Corp. What you would do is just let the income from the S Corp just be income, and then have that, you'll get a Form K-1 from your S Corp. So don't give yourself a 1099. Don't take the deduction, because I don't want to get too technical, and of course anyone can ask me any questions after if you want to set up something where I can give you more one-on-one, but that would not be a good tax strategy to do a 1099 on an S Corp, because you're making yourself pay self-employment tax. So what you should do is just you report whatever income minus whatever expenses that you have for the year, and you don't need to give yourself a 1099, because you're going to pay taxes on whatever's left over in your S Corp. So that's the answer. But moving forward, you should prepare yourself, because the IRS, that could be a red flag if you don't have a salary line. So you want to maybe take baby steps, and maybe in 2016 try to W-2 yourself, because with an S Corp there's something called reasonable compensation. So I hope I answered that. Okay. So there are like 12 ordinary and customary deductions, and they're called the Deductible Dozen. There's home office. These are the most common deductions for businesses. Home office, office supplies, furniture and equipment, other equipment, software, mileage, insurance, retirement, Social Security, telephone charges, and child labor. So you actually, as a deduction, if you have a child, you could employ your child. If you have a Schedule C, meaning you're a sole proprietor, then you do not pay FICA Medicare tax on your child's wages. But if you employ them, they should, let's see, if you employ your child, then I wouldn't say it's a baby. It should be someone maybe 12. They can be like old enough to actually perform a job, and that's a way to shift income in your business. So it's a strategy to shift income to your child. So I want to go on to my next point, which is taxes, taxes, and more taxes, right? So it's very important. Sometimes small business owners, we don't understand the importance of filing the taxes on time. Because when we don't file those taxes on time, there are a lot of penalties and interest that we do not know of. So for example, if you have an S Corp or an LLC, that tax return is due by March 15th of the tax year. If you file that tax return late, for every single partner, or S Corp member, there is like a $50 a month per month late fee for your S Corp. And that has gotten a lot of small businesses in trouble, because you have to file the return on time, or you have to file a valid extension, right? So you would either file the return on time or file a valid extension. But I find a lot of, I'll say, business owners paying a lot of extra fees, unnecessary fees, by not filing on time. And even if you do not have the dollars to pay the taxes, to pay your taxes, you get penalized for not filing on time. So even if you can't pay the actual tax payment, because for whatever reason you just didn't have the dollars, you should still file those taxes on time, because then at least you can get a payment arrangement or work something out with our regulatory agencies if you file taxes on time. Those taxes include payroll taxes, sales taxes, corporate taxes, and the corporate taxes are due March 15th. Corporate means 1120, a corporation, 1120S, S Corp, and then actually the 1065, which is partnership returns, they're not due till April 15th. So they're not due till April 15th. That's what I want to say. Okay, so our regulatory agencies are IRS and then Illinois Department of Revenue. And this is Illinois Department of Revenue. Of course, our state of Illinois is very interesting right now, right, with all the things on budget cuts and everything. So the Illinois Department of Revenue, in years prior, they had not put a lot of attention on if your return was filed late, if your sales tax was filed late. They didn't pay attention to it. Now, I want to say they're very aggressive with late payment fees. I have had several notices come into our office this year on late payment fees, late filing fees. So if you miss a filing deadline, the Illinois Department of Revenue is not granting any leeway in that department. So please file your taxes on time. Also, the Illinois Department of Revenue, they've become very aggressive. So if you do not file on time, or if you do not file your taxes, they can revoke your professional license, right? Also, the city can revoke your business license. But if you are a nurse in a home health care business, they will revoke your professional nursing license that you passed your test and you're certified. They'll revoke your professional license if you do not file your taxes. And I've seen that happen. So, you just don't want that. That can shut you down. Also, I'm sorry, this is the last thing. The Illinois Department of Revenue, like I said, they're very aggressive. They will do site visits. And if you don't pay them, if you're not filing your taxes, they will come to your business and put a big yellow sticker on the front. So always file your taxes on time.
Deanna,
yes.
This is Karen. We've got another couple quick questions that I'll pop in. The first is child labor only for the sole proprietorship?
Okay, no, you can have child labor in a C Corp, an S Corp, or sole proprietorship, but in a sole proprietorship, the FICA and Medicare if the child is 17 and under, you do not have to pay FICA Medicare. But if you have a C Corp or an S Corp, you will pay the FICA and Medicare taxes for the child. But in all those scenarios, you can employ your child. You can employ your child and you can employ your spouse. Because sometimes as a tax person, when we're doing tax planning, it's a strategy to shift income to a lower tax bracket, to someone who's in a lower tax bracket. It's an income shifting strategy.
Thank you. And then the second question is from Patricia. If you don't know what your tax bracket is there a penalty for paying an estimate and then paying more taxes the next quarter?
Okay, there's never a penalty for paying estimates. Our regulatory agencies love estimates, and you should estimate your income. And because it's an estimate, that means an estimate is like a guess. So in that moment when you estimated income and expense for first quarter to pay your taxes, you didn't know that you were going to have such a great second quarter. So it's okay to send in an estimate, and it's best to send in estimates. And if you do better, or once you finally calculate it in the next quarter, it's okay to pay a little bit more on the next estimate, because our tax system is pay as you go. So because it's estimate, you're allowed leeway to estimate. And yes, estimates are good. Making estimated tax payments is preferable. Okay.
Thank you.
So, okay, thank you. This is my favorite story. This is my favorite story for entrepreneurs, for just like, I want to say small business. And this is kind of what I see all day, every day. And this has nothing, this is attached to tax time in a way as it relates to the Women's Business Development Center and their loan and obtaining loans and financing for growing your business, right? When you're ready to grow your business. And I call it the catch-22. And for me, it's the story of the little entrepreneur that cried wolf, right? And what that means is, business owners, I do understand this. We just talked about the deductible dozen. And yes, we want to be assertive and be very tax savvy and reduce our income as much as possible, right? But having more, coming up with more deductions than ordinary and necessary, so that you can reduce your taxable income, may not be the optimal strategy when you're trying to grow. So what I'm saying is, a lot of us small businesses, we will report our income and we will accelerate expenses, meaning have a lot of expenses. So if you have $100,000 of income, then we'll have $95,000 of expense, right? So $5,000 profit, because yeah, we want to deduct a lot of things. But then when it's time to get a loan, or when it's time to go to the Women's Business Development Center and try to obtain a loan, then your loan officer is looking at your tax return, and they're like, you wrote off everything. How can I give you a loan when the income is only $5,000 for the last 2-3 years? So it's a catch-22. Of course you want to include all of your income and all of your expenses, and if in that business year you happen to have more expenses than income, then so be it. It is what it is. You know, you tried your best. But it's not the best practice in a business that wants to grow, that wants to obtain loan, that wants to obtain financing, to deduct everything, to deduct more than your ordinary and necessary expenses. So this is just my own personal, rah-rah, cheerleader for small business owners, but profits are everything. So I know that sometimes and I said, show me the money, right? And I'm an accountant, so I connect with numbers a lot, right? But sometimes in our businesses, we are not focused on making a profit, because I guess we're just going and we're small, and you're going through the day-to-day, and we're wearing 10 different hats. But I think profits are everything, because when you're in business to make money. You're in business to make money, so that I guess then you'll have to do some tax planning. but I just wanted to remind everyone we're in business to make money. Create assets, stay happy. It's good to have decent cash flow. You're not in business to pay your vendors, because sometimes we're going through the whole business year and we're working and we're not paying ourselves. So it's hard, like, to go through your business year and not pay yourself. That makes that business hard. It makes it more of a struggle. So I guess my advice is have a plan and follow your business plan. Because what happens if you go through your whole year and you're paying out vendors, you'll look up and you didn't pay yourself, you've only paid vendors. So it's okay to sit down and strategize about your business, your different profit centers, and what that means is like your different ways to make revenue in your business. So if you had I'm gonna do the hair salon example. If you had a hair salon, well, you have hair services where you're actually curling, pressing hair. Then you have, maybe you're selling accessories, so hair accessories or like extensions. And then you may have a third service of, what else in the salon? I don't know. Those are just, in a salon, those may be the two profit centers. Maybe selling extensions and then also doing the hair. Oh, and then you can also sell the hair care products. So those are three different ways you can generate income in your business. And I like to remind people that you can make money in your business. And I said, he who fails to plan, plans to fail. Planning without action is futile. Action without planning is fatal. Okay, then we're going to reasons businesses fail. Businesses go under for two reasons: if they're currently out of capital, or if the business capital or money will run out in the near future. And that's when you can align yourself with the Women's Business Development Center so that you can have enough capital to grow your business and to grow your profit center.
Deanna?
Yes.
We've had another question come in. This is also on the quarterly estimated filings. The question is, for quarterly tax filings, let's say I paid $25,000 in a W-2 for myself when my income was actually $40,000 for the year, and she's the owner of an S-Corp. So she paid $25,000 on a W-2 and her income was $40,000. How would she file the next year's quarterly filings when she's estimating income? Okay, when estimating income is only at the end or the last quarter. Asma, I'm not sure that I'm fully understanding your question, but I think it comes down into some fairly specific things about how to estimate your next quarter's taxes.
Mm-hmm. So in that example, it's $40,000 for the year, and then the W-2 is $25,000. So we can to W-2. On the W-2, you're paying taxes throughout the year. So we would only need to estimate on the $15,000 that's left over. And then how do you estimate that? It just depends on kind of your personal situation. But for me, as a rule of thumb, then I just 15% is like an average tax bracket. So what I would do is I would estimate to pay 15%. So that's like what, 22,500? I mean 2,250 for the year on that $15,000. So, and then I would divide that by 4. So I would take 15% of the income. I'm going to use round dollar amount. So if it's $10,000, right? So then I would take the $1,500. $1,500 is what I'm estimating my taxes would be. So $10,000 is the income. $1,500 is what I'm estimating the taxes to be, and then I would divide that by 4 and pay estimates of the $350 each month, each quarter.
Thank you.
Okay. Do we have any more tax questions? So then I'm almost wrapping up, and I may want to answer more tax questions, but I just said, just like when you're trying to plan your business and for tax time, really your relationship with your accountant, your business accountant, should be throughout the year. So you should meet with them at least 2 or 3 times a year, because what happens is when you wait and hold your records and your income and expense the entire year, and then we get to tax time, well, your tax accountant cannot help you. We can't help you strategize or change anything from the year prior. All we can do is prepare a tax return. So you should get advice. It's kind of like seeing the doctor. You should see the doctor at least 2 or 3 times a year just for consulting and for planning for your next year. But what I was telling everyone, accounting is the language of business. So a lot of us business owners don't understand that that really is like the backbone of your business, understanding, because our business is about making money, which includes our numbers. So accounting helps you understand those numbers, because not only do you have a service, but then there's numbers attached to doing your business well. So I think that keeping up with those numbers, meaning using the QuickBooks Online, the FreshBooks, or some sort of general ledger accounting system on a regular, consistent basis, and not necessarily waiting till tax time, helps you to just prepare yourself for business growth and business health. Your business being healthy. But I said all successful businesses have an accounting department, and you should take time to do tax planning, which allows you to have tax savings and write-offs. But hire a good accountant. And then this is my information. So I am at Grants Financial Services on Facebook and Twitter. On Instagram, I'm Tax Boss Lady. And then my email address is deanna@grantsfinancialsbcs.com. I actually have a business and expense deduction spreadsheet that I could send out to anyone that requests it from me. So I have a spreadsheet that includes not only the Deductible Dozen, but it's about 30 or 40 different ordinary and customary business expenses. Now I can answer any questions, any specific questions now.
Thank you, Deanna, very much. And while we're waiting for folks to type in questions, I want to do a little advertising for some upcoming events and services that we have here at the WBDC. We do a monthly series of webinars, in addition to these kind of special tax-focused ones, on something called Growth Wheel. And those are tools on a wide variety of entrepreneurial and business topics. We've got one coming up next week on engaging customers in conversation, so kind of a sales topic. And then we have one next month on improving cash flow. And we do an introduction to what Growth Wheel is on a monthly basis as well. You can just go to wbdc.org into our events and see those. And then another event I want to draw your attention to is also next week. We're having a business plan critique clinic. So if you have a business plan that you want to kind of dust off and see how that might be able to kind of become more relevant to you, helping you grow, those clinics are free. You do need to register in advance. And then the last thing I want to remind people of is that our one-on-one business advising is actually at no charge to you. We don't want to say free because we get tax money, speaking of taxes, to help pay for some of those services as well as private contributions. And so you might as well come and make good use of your tax money that you have paid us, so thank you very much for that. Are there any last questions? I haven't had any pop up. I do appreciate the good questions that people have asked so far. Okay, here we go. Lee asks, regarding retirement deductions, does this mean I can set up a retirement plan through my S-Corp, and if so, how does that work? Deanna, do you want to give kind of a summary answer? Because I'm sure that this is a lot more detailed than you can answer just here today.
Mm-hmm. So how does it work to set up a retirement plan? Well, I guess I would.
I think the first question is, can she set one up in an S-Corp?
Oh, yes. You definitely can set up a retirement plan in an S-Corp. Yes. You can definitely set up a 401k plan. Because an S-Corp works just like a corporation, and corporations, you could set up a 401k plan in your S-Corp or any of your businesses, C-Corp, sole proprietorship. You can set up retirement plans in any of your business units, like I said, C Corp, S Corp, sole proprietor, partnership. And once you set it up, it is a legal tax, it is a legal deductible tax expense, and it's actually one of the strategies to reduce, like as accountants, that's one of our strategies to reduce taxable income is 1, set up a retirement account, 2, fixed assets, meaning purchase either, not necessarily purchase a vehicle, but purchasing whatever equipment is necessary for your business to grow so that we can accelerate the depreciation. So what that means is if you're a printer and you buy a $10,000 new printer for your business, then as a tax deduction, there's something called Section 179, which is accelerating the write-off. Because when you have a fixed asset, so I'll say an asset that costs you $5,000 or more, and that's kind of my rule of thumb, then what the IRS regulation says, because I can use that piece of equipment for the next 5 years, that I should deduct a percentage of that equipment over time. So you would deduct the $10,000 over a course of 5 years. But they also have a strategy called 179 where I can accelerate the expense, and so I can take that $10,000 and write off the entire $10,000 only on first year of acquisition. So this is one of those things that if you had bought a piece of, if you had not seen your tax person and did tax planning, and they did not tell you, okay, well, this is what your income is looking like in the 4th quarter. Well, when we get to today, if you had an amazing business year and your income is $100,000, if you did not get tax planning service like 4th quarter of 2015, then when we get here, there's not much that we can do to help you as a strategy. Because so if you would have maybe met with your tax person in 4th quarter, and that is part of the strategy that you can discuss. Okay, we're going to now, we have $100,000 of income. Okay, what can you do to reduce that income? You can set up a retirement plan, which yes, is a deductible expense, or you could buy some necessary equipment or fixed assets that will help you in your business.
Deanna, thank you. We've got another couple questions. The first is, can I increase my quarterly W-2 filings quarter after quarter depending on my earnings?
Yes, you can. Yes, you can. Actually, as a strategy for smaller, independent, privately held companies, you can, depending on your cash flow, as long as you give yourself, pay yourself a W-2 or a salary within that calendar year, as a strategy, if you're a seasonal business and your business is slow, just say 1st or 2nd quarter, then you could report 941. You can report 0 payroll filings 1st quarter, 2nd quarter, and then if your money comes in 3rd and 4th quarter, you can then pay yourself more dollars because now you have cash to pay the payroll taxes that go along with payroll. And as long as you're paying it within the calendar year, you can change it from quarter to quarter as you wish. So, because the W-2 is reported on a calendar year.
Thank you. And here's a question, a specific question about filing sales tax returns in regards to retail clothing. The form asks about sales made outside of Illinois and provides a lower tax percentage for such sales. However, there isn't a line about sales made and shipped out of state which are non-taxable. Can you please provide insight about how to file those non-taxable sales?
Non-taxable sales are like, there's a 2nd page of that sales tax return, and I believe it's line 10. So anything that's non-taxable, so for example, if you do work with a nonprofit, usually those sales are not non-taxable. So there's a line 10 to report non-taxable things, and then it will calculate and take it and deduct from page 1 of that sales tax return. So on page 2 of the sales tax return, there's like a line 10 where you would enter that information.
Thank you. And we have a question: is buying business property tax deductible? And Asma, I'm going to assume, Asma asked the question, that you mean real estate. If you mean other kinds of property, shoot me another question to clarify. But I'm going to ask Deanna to answer the question about real estate.
Yes, real estate is a valid deduction because instead of renting a space out and paying rent, which we know rent is a valid business deduction, you could purchase a property. And then you could actually close with the property under your business name. And yes, you can deduct the mortgage interest and real estate taxes of that property, of the real estate property purchase, as well as you're able to depreciate the value of the property over time. So that's one of those, that would be a fixed asset purchase. And so just say you bought a building for $100,000. Well, since it's commercial property, I can take, you actually depreciate it over 39 years, and not to get too technical, but I can write off an additional $3,900 a year for buying the building, plus I get to deduct the mortgage interest and real estate taxes, plus ongoing maintenance of the building, as long as you have placed the building and closed with it under your business EIN. So the deed needs to be with the business to deduct it on your business. But there, of course, is different strategies for that too. So.
Right, because I know sometimes people will buy the real estate in their personal name and then rent it to the business.
Right, which I prefer.
And can you maybe talk briefly about why you prefer that?
One, because then that way when I sell my business, or if I decide to sell the business, then I don't have to sell the property, or I could sell it as two separate things, because you having a business with a customer base has its own value, as well as deducting it on your as well as owning the property. But I find that the real estate is one of the most tax advantageous deductions, just period. Like on a personal level, the tax laws and the tax laws that surround income, when you have income and you own rental property, is just very favorable for real estate transactions, meaning you pay less taxes when you're dealing with real estate versus having commercial transactions, right? If I have a business that made $100,000, or if I had real estate that made $100,000, I'm going to pay less taxes with real estate, and that's just how the tax laws are made. That's just how it is. And we know Donald Trump. And long story short, but anyways, I prefer it. I prefer it because it's just a better deduction on your personal. I can now give my clients more of a deduction on their personal. And then because the business is going to have the deduction period, they're going to have that rental income. But I can find a way to strategize between owning it personally and the business, and connecting those two, and giving you the best bang for your, buck per se.
And on a related note, the question is the 20% down payment that you put on that real estate applied to principal, and it's 20% of the purchase price, is that also deductible?
No. No. The only thing that's deductible is the entire cost of the real estate purchase. The 20% will not be deductible. The 20% only reduces your mortgage payment. It reduces the loan amount that you get, but it's not, that 20% is not deductible. It's not an additional deduction. No.
Okay, thank you. Asma, did that answer your question? And okay, thank you. She said yes. And if anybody else has any questions, we're going to wrap up in a couple minutes, but if there's any last burning questions, Deanna, I so appreciate your partnership with the WBDC in providing this really super helpful information for folks. I do want to remind people that we are available to help you in growing your business, and you can find out more information at wbdc.org. And I don't see any other questions coming up. So if you If you're in the middle of typing one, just hit enter and then I'll hold on for a minute. Okay, it looks like that you have answered everybody's questions, and thank you very much, Deanna. Everybody have a great afternoon and stay warm out there.
Thank you. Thank you so much.
Thank you.
Bye.
Bye-bye.
Thank you. Bye.